Hey, what's happening, guys? How's everybody doing? My audio okay? Video okay? You guys hear me? Give me a thumbs up. Let's refresh just to be sure. But yeah, we good? Cool. Okay. Just before we start, I like to just do the reminder that these are always recorded, and if for whatever reason you can't make it, um, they are up on T3's website. So under the options and play tab, they're there at your disposal. So you can go back, go over, if maybe if you showed up late or if you missed it, or even if you want to go back through some of the ones that we've the some of the sessions in the past. I mean, they're up there, so utilize them however you want. That's what they're there for. If you have any questions, so if there's something that we covered and you weren't able to make the session and you wanted to follow up on something, please don't hesitate to reach out. I really appreciate all the questions, and if I can um, turn it into a video. So if it's like something that I think like a lot of people might appreciate, I'll do like a weekly video out of it or a daily video. So if you do have any questions, like I really, it's not any inconvenience to me whatsoever. Like I really do appreciate when you reach out with those questions, and if I can help, I'll try my best. All right. Um, So, I like to go over like the state of the market, right? To kind of get things going here, and we have had some pretty big developments. Now, we haven't necessarily broke the trend. We're in danger of doing so, and you'll see like when I talk about the cues in a second that the difference between Nasdaq and S&P is starting to separate a little bit. So for a while, these were like lockstep, just moving in tandem with each other, and then um, early last week you had spiders. Well, I mean, it was actually set up by like the 2 Fridays ago. So you had the real heavy down day that put us below the 8, and then last Monday we had a pretty significant gap down, and spiders lost those two really important momentum moving averages. Right, we've talked about it in the past that the eight is really like the momentum indicator. So as long as we ride the 8, things just really seem to respond so well on the bull side. Breakouts, continuations, trend reversals, what have you. Right, the 20-day is kind of the line in the sand. So like we've dipped below the 8 in the past, but we kind of bounced right around the 20. So we kind of rescued like the really aggressive uptrend. We lost the 20, right? We bounced. We tried to reset above it last week and we failed. And then we rolled over on Friday and we hit the 50-day for the first time since the beginning of October. So right now we've lost a lot of like the momentum on the bull side. We haven't gotten hit too bad, but realistically, if we lose that 50-day, it could snowball to the downside very fast because we've already lost like that really strong momentum from October on, and now it's just whether we can kind of repair the charts after rolling down a little bit. And really, like the key thing you want to watch is the 8 and the 20-day because if we can get back to that, then we reset the pattern and like the music starts up all over again, right? Like I like to say, it's kind of like musical chairs in this tape. It's like when the music's good, everything just keeps moving and running and breaking out and rallying, right? But once the music stops and once we break those trends, then you got to be really careful because things can really snowball pretty quick. We've seen it in the past, right? Like when we break like these long trends. Um, so like in May, right, broke a long trend, pretty quick move lower. Last year, right, we broke a long trend, quick move lower, and then people were talking about the parallels between beginning of 2018 and October 2018, and now we know what happened both those instances, and now it's just whether we repeat that for the third time, right? So the 50-day is like your real key focus point on the downside. If we lose the 50-day, you're expecting probably something closer to like 311, 310 to get into that 100-day. So really big window underneath if we lose that 50-day, which right now is at 320, it's right around 321, so 320.94. On the flip side, if we can get back above like 328, then we reset above the 8 EMA, we reset above the 20-day, and then that bullish trend from October looks better. It looks like it could potentially be resetting, and we might start to see things act a lot better. All right. Uh, Now, I mean, like, obviously, a lot of the action recently has been dictated by headlines, and like it's really like it's a really bad situation in China, and today the markets opened and they got hit pretty hard. So we responded better than I think people were fearing, but at the same time, we're kind of still in like a headline-driven tape, and you gotta be careful because things can really like. Things can really gap pretty significantly overnight, right? Especially when like the headlines are driven by like the Chinese market, right? Because like the Chinese market is basically trading when our markets are closed, so our overnight risk is probably going to be higher. So just something you got to take into account, right? That if some major development happens in China when all markets are closed, we could come into a significant gap, either up or down. So the overnight risk is definitely a lot higher in this like news-driven, headline-driven tape. All right, so just something you got to take into account. That's why like options. Uh, I, I I like having like those downside hedges just kind of in place, because sometimes it can be really hard to time a move lower perfectly, because like you might get like that headline overnight and you might end up like last Monday you come into like a 400 or 500 point gap down. Uh, uh, sometimes you can anticipate it, sometimes you can't, and that's why like I really feel like hedges are something that we spend a lot of time talking about. I think they're like important a lot of the time, especially now when you have some 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 signs that we're breaking trends, some signs that we could really start to see a more significant pullback. So if you haven't really thought about hedges, or maybe you've been kind of reluctant to put them on, I still think it's like a pretty good idea, even though we are off our high. I mean, because I do think if we lose this 50-day, that you could potentially see like another like 9, 10 points lower relatively quickly. I mean, because things really kind of open up underneath that 50-day on the spiders. Now, Qs, like I said, a little bit different. And actually, the Qs are still in that trend. So you can see that the Qs really never broke the 20-day. They did get below it. They closed below it last Monday, and then they actually closed below it again on Friday. But you can see that the performance was a lot different. So whereas the spiders bounced and couldn't really get back to the 20-day Tuesday, Wednesday of last week, the spiders bounced, got through the 20 and the 8 EMA, and then when they rolled over, they really it was only like a marginal move below the 20. So with today's bounce, the Qs are above both of those moving averages. So you can see, I mean, like really clearly that the Qs are at the moment the leading average. So tech is leading. I mean, that's not surprising. I mean, with like Microsoft at a 52-week high, Google's getting hit after hours, so that's going to be down a bit. But I mean, Google, Apple, I mean, a lot of these big tech names, Amazon, right? Like they've had for the most part pretty excellent quarters. So I mean that whole like mega cap tech trade that's really kind of pulled us higher over the last few months. I mean, it seems like it could just remain in place because I mean the numbers were really fantastic. I mean, Apple beat and raise, Microsoft beat and raise, Amazon beat inline guidance, which is actually a lot better for them because they've guided lower the last couple quarters. Facebook got hit, but again the numbers weren't too bad. Google's off a little bit after hours. We'll see what that looks like tomorrow, but yeah, I mean like the numbers really have been pretty fantastic in that sector. So. Q's definitely leading. Dow a little bit different. Dow is actually below the 50. So I mean, you can see like when I start to pull these charts up, right? You can see just like in relation to one another, like where the leadership comes, right? Because the Q's above the 8, above the 20, right? Spiders above the 50, but below the 8 and the 20, and then like the Dow is the weakest of the three because that's below all three of those moving averages. So it violated the 50 on Friday, and it bounced today and couldn't reset above it, right? So um, we'll see how this week goes. I mean, it's another busy week of earnings. The Fed last week, not a huge event really. So as we go forward, I mean, it's going to be earnings and it's going to be coronavirus updates, and like that's probably really what's going to drive the tape in the near term. So we'll see. But again, I really think that like if you haven't thought about hedges, or you've been reluctant to put hedges on, even after the move lower we've had, I still think it's probably worth taking a look at, just because if we do pull back and we start to break some of like these higher levels of support, right? If the spiders break that 50 days specifically, I mean, the Qs, if they really lose the 20, I mean, there is still a significant, there could potentially still be like significant room lower. So I still think it's worth taking a look at, even if you haven't put them on, and maybe miss like this initial like little pullback. All right. And then the IWM. So we had to close this one out because it similar to the Dow, it basically burned through most of like the higher levels. So it hasn't broken back below 160. So 160 was like this long area of resistance, right? So we've talked about this. You can see that 160 is like this long area of resistance. So it hasn't broken back below it. But at the same time, because this was a shorter term strategy, at the same time, like losing the 8, then the 20, and then, it was still okay. I mean, it didn't look great when it was like hanging above the 50, but it was hanging around enough to maybe justify sticking with the idea. But then when it lost the 50-day and it started to roll over, I mean, like there's like from like a near term perspective, it seems like really hard to justify, right? Because I mean, you need such a significant bounce now to even get back above like certain key levels that maybe from like a 2 month, 3 month, 4 month, 5 month perspective, it still looks all right, especially if it's above 160. But from like a 2 week, 3 week, 4 week perspective, I feel like it's definitely more challenging. So that's why like the trade was I mean, we were able to roll it up initially. So when it popped, we were able to roll, but the remainder of the trade was through February 21st expiration. So it wasn't enough time, and the stock or the ETF down here, I don't think it warrants like initiating a new trade or maybe adding to it. So that's why I just thought it made more sense to close it out. All right. Any questions? Some other like kind of important developments. So treasuries, right? So this is actually what we spent a lot of time going over last time, and um, I was talking about like the parallels between um, basically. Well, I'll just do short term. So I was talking about like the parallels between kind of what GLD looked like before it had that really big breakout in December, and then TLT. And now you can see that TLT is basically mirroring that like almost perfectly, right? So take a mental picture of this, right? And now look at GLD um, here, right? So check this out. I mean, you can see like the similarities, right? So basically, GLD broke out December. Its initial move kind of carried it. It kind of like it kind of had like a real fast move to take out like this initial pivot, right? Then it got into like the secondary pivot, and then it exploded up through like the top, so like the high from September, right? So you can see, take a mental picture of this chart, and now as it compares to the TLT, right? You can see how things are developing. So had a fast move, took out the initial coming into the second, and now you can see if you get like that real sharp explosion to take out the high, because that's basically like the last target for this trade is like a retest of the high, which is up at like 148.50, 149 area. But you can see like, so like we actually spent some time going over this the last time we got together, and because like it really was such like a similar setup, and gold triggered in December. So I mean that happened first. but TLT triggered, and now it's starting to move, and you can see like how gold developed, and then you can see like how similarly right now TLT is developing. So everything looks good, and I honestly I feel like maybe you get one more like leg lower in the market, and that might be like the trigger to really set this up for like that retest of the 52-week high. It's up at like 148.50. So like into that 148, 149 area, like that's where I'd be like booting out probably like the remainder of the trade, or maybe even just like scaling back risk much further, because above that, yes, it could take off, but I still feel like that's like the ultimate target of the trade is the retest of this high. So uh, the March 20 call spread, it's still really like a solid time frame. That's about 6 weeks, I believe, 6 to 7 weeks. So still plenty of time for that to play out. I mean, again, like I think like all it really would require is maybe like one more scare for the market, or one more like significant down day for the market to kind of like send a bid, or flight to safety and a bid to treasury. So overall, I feel like it's developing very well, and I still think like what you're looking for is one more sharp move. It could come pretty quick, so you're gonna have to be like ready to exit once it gets up above like 148. But I still think it's setting up pretty well. All right. Um, Oil. Just we'll talk about oil and VIX just quickly. Just ugly action in oil. I mean, coming into the year, I thought maybe right oil was acting better. So, as we got into January, you're looking at like the chart of oil, right? So that's going in. That's going into January. You're thinking, wow, like oil. You're thinking, all right, oil's really set up well. Got the year end move. Energy was one of the biggest laggards last year, from a sector performance perspective, right? So oil's starting to look better. Energy starting to look better, right? And then all of a sudden, I mean, things just fell apart so fast. Oil has gotten hit very sharply. XLE has gotten hit very sharply. It actually took out the 2018 low, and oil. So USO, like I talk about USO, but basically this drop today put WTI below 50, which is important because it's kind of like one of those round focus levels, like, or it's like a hedge level where a lot of like institutional trades like happen around it. So losing 50 could, if it can't reset above 50 quickly, it could trigger like a whole nother wave of selling, for people that maybe like just like traders or speculators, or even like hedge, E&P names, energy names that are hedging. So it's definitely been a very rough couple weeks for anything energy related. I mean, like Exxon earnings got hit, right? Oil's dropping, like things are just dropping. So we'll see how this develops, but right now, I mean, like there still doesn't seem to be a floor. You're getting consistent like 1, 2, 3% down days. Oil majors, like I said, like Exxon's at like a 10-year low. Get rid of some of these. So I mean, this thing has lost so many big levels. Chevron's starting to break down too. And it's, I mean, it's just some tough action. So kind of monitoring it, but at the same time, like, I really feel like to bottom feed, you need some sort of like compelling reason to get involved. Like, and then like any trade would probably be either like very short term, so like maybe like options like a couple weeks, so like a 2 week time frame, or even like a week time frame, or like 2 to like 5 months out, where like you're thinking like, okay, maybe if there's like a rebound, like you get like kind of like a sustained move over like a longer period. But like right now, it's just the action is still so sharply negative that I'm kind of just like waiting and watching. Yeah, just oh, just things turn lower so quickly. And then VIX. So like we'll just go over this quick VIX. But you can see that it jumped a bit, and what's interesting about this is basically that from where it's at, it essentially is either going to fail or it has room higher. I mean, like over like the course of like the VIX, over like the course of the last year, I mean, you basically have like two different trades, right? It either has like these marginal moves up into like the high teens, right? So like basically where it hit right here, or so I guess there's essentially like three levels. So it's like the high teens, right, which is kind of where it hit, and then above that it's the mid 20s, and then if it gets through the mid 20s, it's basically closer to like 30. You might get like that real significant blow off move. So right now you have like the first kind of level hit, and it's whether it's like it stops and stalls and starts to roll back down, or if it doesn't, then what you're looking at is like another extension probably into like the mid 20s, because that seems to be like the next area, right? You can see like the mid 20s. You've had a bunch of tails into this area, and then if it gets through the mid 20s, then you're looking at probably 30 and maybe even like this really like crazy tail like above that. But like it's basically like teens. So if it can get through the teens, you're looking at 25 area, and if it gets through 25, you're probably looking closer to like 30 on the VIX. So, at the moment, I think there's still a lot of decent positioning. 50 Cent, we talked about the VIX trades last time, but like 50 Cent still like coming in. You're seeing some like real big size, out of the money, like late February. So people are still interested there, but I mean, we've been involved with the VIX many times and long enough to know that you have to sell into strength, because if you overstay your welcome, I mean, like this thing just kind of just retreats slowly back down. So in terms of like the VXX and UVXY, it's like it's important to sell into strength. So we'll see if you get like that next leg up. And it's not something that I'd be interested in rolling. It's basically like you sell into strength, and then if it comes back down, you entertain the idea of maybe adding it back. But it's not like roll. It's not like take money off and roll. It's like you once it pops, when you get that sharp pop, you have to close like the trade. I mean, like that's just how it goes. All right. Um, any questions? It's all right. I know I kind of like once I get going, I just start I can really get into it. But yeah, any questions about anything we went over? No. Okay. So today's lesson, or if you want to call it that, I mean, it's kind of just like um, it's like tips for spreads, okay? Because it kind of came up with the Amazon trade from Friday, well, Thursday into Friday, and what was what was like a fairly deep in the money after Amazon beat and the stock ripped. I mean, like the call spread was like fairly deep in the money, um, but that the nuances of option spreads, kind of, like if you'd come in like thinking it's going to be like 100% max gain. I mean, obviously like that was the case, and I thought it was like a good idea to maybe go over some of like the factors that go into like determining like when to close, when to hold, why to close, right? Like these spreads, because they're different than just straight calls, straight puts. Um, so I I'm sure you've noticed, like I do a lot of spreads around earnings. Well, I do a lot of spreads in general, but I do a lot of spreads around earnings too, around like major catalysts, and really because it's just like a great way to just lower your debit, or your net debit, right, or lower your overall risk, with maybe like expensive contracts premium wise. So like if they're like they cost like 20 points, 30 points, 40 points, whatever, right? Like for Amazon, or maybe implied volatility if they're like 150 implied volatility, 200 implied volatility, right? So like some bio events, you might see like these really crazy implied volatility numbers in like the 100, 200, 300 area, right? So spreads, they're just like a really good way to like manage your risk better. I mean, instead of like paying like straight call, straight puts, um, for those elevated premiums, um, spreads allow you to kind of get the overall risk down. And while there are plenty of reasons why I like them. There's also other um, reasons why I don't like them, right? There's other like drawbacks, and one of like the major drawbacks is that by turning like by opening a spread, you basically forfeit upside potential, right? Because you cap your max reward. I mean, by lowering your net debit, you also lower your reward potential because, like in the case of Amazon, it went almost it went almost 100 points above the top end of the spread, and if you had just had like a regular call, then you would have participated in anything over 2,000. But because there was a spread, I mean, basically above 2,000, like everything was capped, right? So there's pros, there's cons. Um, but for me, like I really think most of the time that the pros outweigh the cons around major catalysts, just because I find them so useful to manage my risk better. So calls and puts, I mean, like they're literally like your building blocks of options. They're the most standard, right? And they're really the most easy to manage around earnings, around other events, because you have a lot of flexibility. Okay, and one of like the main things in that regard is that when you have like a multi-leg strategy, so like a spread where it's like it's two contracts, right? So it's two contracts for one position. It can cause slippage. So meaning that instead of like just because like a bid ask spread for one contract is it's one thing, right? Like you mean like you're trying to get out, then you got to like maneuver for the bid ask spread. But if you have to get out on two contracts at the same time, then that's two spreads you have to like kind of maneuver with, right? So there's a higher chance of slippage, meaning like you don't get the price you want because you have to maneuver getting out of multiple contracts at once, right? Also, like slippage happens if things are like especially like around earnings, you can see like the spreads get very wide, so it can be even more pronounced on names like Amazon when like the spreads are like for instance like I think at one point like the for those February '07 call spreads, I mean they were pretty far in the money, but at the same time like the spreads on the contracts were like 3 or 4 points wide. So that's kind of crazy because if the net debit was only like $1.25 or whatever, like it was like a somewhere between like $1 and $1.50, but like you're trying to get out and the spread is you're trying to get out for somewhere around like 7 points, but the spreads on each contract are 3 or 4 points wide. I mean like that's really significant. I mean like that can create a ton of problems getting out because if you're trying to like close it for like a net 7 credit, right? Or trying to close it for like 7 points, and the spreads on each side are 3 or 4 points wide. I mean, they can really, it can really eat into like that overall like reward profile. And then the other reason why calls and puts are I find calls and puts can be easier to manage around earnings because you can box them, right? And that's like really underrated in my opinion. Like if you have like a big move after hours, you can reduce risk better with just standard calls or puts because you can like if it's a call, you can sell shares against it to basically lock in the trade, right? But if you have a spread, you can't really do that because if you sell stock, then you're basically changing the risk profile in the sense that you're basically like doubling up because you already have one short call, and if you sell stock on top of that, then you're basically in theory like net short, right? And if the stock keeps running and running and running and running and running, then any potential profit you would have made from like the call spread is starting to get eroded or even like erased by like that short stock on top of it. So you can't really box options if you have spreads versus like standard calls and puts. You can. So it's definitely one of the drawbacks. So when it comes to spreads, what I like to weigh, there's a few factors that go into it, and one of like the major determining factors is going to be how much time is left on the spreads or how much time until expiration. Okay, and for me, what I like, and I'm sure what you noticed, is that a lot of like the earnings related trade ideas that are spreads, or even if they're not spreads, but a lot of the earning related trade ideas are either like I don't do a lot of week, but like 2 week time frame. I'm sure you probably noticed like a lot of like the earnings related trade ideas are like the 2 week time frame, and like that's for a specific reason. It's because there shouldn't be that much time value built into the contracts. The weeklies will have the lowest amount of time value, but like that 2 week, there also won't be that much time value. I mean, a lot of the premium of contracts like 1 to 2 weeks out around earnings are going to be built into like that event, that catalyst. So, even going out like that one extra week, so like the second week, it shouldn't be that much time value. Most of the premium is going to be either intrinsic or like implied volatility. Okay. And another thing that's going to be really important is like where the stock is in relation to spread. All right. So if it's at the money, if it's in the money, or if it's like way out of the money, like that's really going to that's really going to weigh uh, on like how much like the position moves, right? How much of the gain is, how much the loss is, and like that's really going to be a determining factor on whether whether it makes sense to continue to hold or you close sooner, right? Like whether you want to like hold and try to like maximize more profit or squeeze out more profit, or if you want to like sell sooner. Okay. So I'm going to go over examples. I mean, if this is a little bit, if you're having a hard time like following, you'll see like when I start to go over examples what I mean. But these are just a few of the things that like I take into account when I'm trying to figure out um, uh, when I want to get out of spreads, like when I want to hold spreads, and like this is really just around catalysts because swing trades generally different. I mean, there are some, like some of this will be like a spillover to swing trades too, but for the most part, like you have like a wider window to exit on swing trades because they're not going to have um, normally they're not going to have the same amount of implied volatility. They're not going to be as volatile. You normally have like smoother moves, more sustained moves, not as wide ranges. So like right now, like I'm just kind of specifically talking about like catalyst trades, like earnings trades. All right, so just first off, we'll start with like spreads that are deep in the money because those those in theory should be some of the most easy to manage. Okay, because really like the contract should be very close to intrinsic value, meaning that they should be very close to how much the contracts are in the money, right? So um, if there's not a lot of time, so if there's only like 2 or 3 days time, and the stock and the contracts are very deep in the money, then they're probably just going to be trading for intrinsic value, right? And in that sense, the reward profile is essentially maxed out, right? Like if your spread is if your the stock is like significantly above where your call spread is, and you have like a call spread that's 5 points wide, and the call spread's worth like 490, then basically your spread is in theory like maxed out. Yes, like there's still like an extra 10 cents that you could potentially make, but that upside potential is very small compared to the risk of you run of it coming back, right? So like, like that's why you'll see like if something like has like a really big gap and it's like capped out, I'll say like like the reward is basically capped from here, and a lot of that has to do with like the risk reward potential that's spread at that point, right? So if it's like a 5 point wide call spread, right, and it's currently worth 490, then is it really worth the risk of continuing to hold for that extra 10 cents, and then a potential pullback or maybe some bad news happens and the stock drops really significantly, and you're giving up potential gains on that spread because you're holding trying to get like that extra 10 cents, right? To me, like a lot of times it just doesn't make sense to do that. Like I'd rather close it out, lock in the trade, and not try to like squeeze out every last cent out of the position. Now, if you do end up holding though, um, something that you want to check with your broker is that for a lot of brokers, like you don't actually have to close out the spreads if they're deep in the money. So if both sides close in the money, whether it's call spreads or put spreads, a lot of times like you don't have to close those out. They just like they'll like the long side and the short side net each other out, and then you basically maximize like that spread. So it's like it's something that you want to check with your individual broker to see what their rules are, because like there may be different rules and regulations for each individual broker. But you know, if it's like expiration day and your call spread is significantly in the money, then instead of like having to like close it out that session and maybe have like, you know, a few cents slippage, you can just hold that into expiration, and like the long side of the spread and the short side of the spread will net each other out, and you don't have to worry about closing it out because like it'll just net itself out at expiration. Okay. I know actually like a lot of people aren't really familiar with that, but something you want to like check with your broker with first. But a lot of brokers have that policy where you don't have to close it. It'll just this is only if both sides are in the money at expiration. Okay. All right. So now we'll do like a different scenario. So if the long, say like the long end of the spread is in the money, but the short end is out of the money, then that position is almost definitely not going to be at max gain. It'll probably be somewhere closer to like the middle of like the max gain of that spread, right? Because depending on how much time value is left, um, that out of the money contract is going to have either time value or implied volatility, but probably a combination of both, right? So even though like your one contract is in the money, the one out of the money is still going to have premium, even though you know it might be like a few points away, right? So um, these are the ones that are a little bit tougher in terms of like managing, because you really need to weigh the benefit of holding that position longer, right? Because um, yes, like one side, what one side is in the money, and it looks, you know, it looks pretty good at the point, but like um, does it look like it's going to continue, right? Because you know, with only like half in, like half out, it's like you're probably only around like maybe like 50% or you know 40 to 60% reward profile. So you really got to figure out like, does it look like it's going to continue in that direction? Does the stock look like it's going to continue higher or going to continue lower, right? Then you have to weigh how much time is left until expiration, like because that out of the money contract, like you know, if it's like 2 weeks left, then you're really gonna probably have to be patient to see like the time value start to erode, and that implied volatility start to erode. But if it's only like 2 days left, then maybe you want to hold on because like that time value could really erode really quick, right? Or the implied volatility could take like a really sharp drop really quick if there's only like a short period of time left until expiration. And then like similar to what we just talked about in the last case, it's like how like what's the risk reward at this point, right? Like if you're over 50% max gain, then you have to like weigh the benefit of holding and trying to get more out of it versus running the risk that the stock reverses, and then the spread starts to move lower or move out of the money or even start to get hit, right? So if it's like a greater than 50%, then you have more downside risk, right? So if the reward currently or the gain currently is greater than 50% of the max, then you have more downside risk than upside risk. If the current gain is 40% of the max potential, then you have more upside risk than downside risk, right? So I like to view things from the perspective of how much is the current gain versus the max potential gain, right? And like that is going to help me possibly like you know determine whether I want to keep holding or whether I'm more antsy to close. All right. And then last but not least, but like so, if both sides of the spread are out of the money, then it's definitely not going to be a max gain. I mean, it might not even be up, to be honest. So both of those contracts are going to have implied volatility premium and also time value premium, right? But that closer to the money contract, so the one that you're long, is going to be worth more. All right. And what I find is that if expiration's closer, um, it might be better to close it out quicker. Okay. And then that's just, similar to like short-term options in general. That, things that are closer to the things that are at the money, or close to the money, when you're going into expiration. These are the ones that really run the risk of taking like the sharpest hit if there's like a move against you. Um, and what's also worth considering is that, say it's like, maybe it's like still like a couple weeks out, but that further out of the money short side really took a dramatic hit, right? So say like um, earnings played out and it didn't have a big move, and like the further out of the money that you sold short. So I'm just talking about call spreads in this case. So say like the call spread, like the short side of it, really like lost like a significant amount of premium, right? Like maybe like a lot of like the value of that contract was implied volatility, and it lost a significant amount, and it's only trading for like a few cents maybe, right? Or less than like 10% of the original. Then what I like to do sometimes is potentially buy that back and like uncover the spread is what it's called, because if it doesn't change the risk profile materially, it can sometimes be beneficial, especially if there's more time left. If there's only like a day or two, so if it's very short term, then I probably wouldn't think about doing that. But if there's maybe like 2 weeks left and that further out of the money contract really got hit very, very, very hard, then I might think about it. Because like over like over like, like 5, 6, 7, 8 days, a lot more things can happen versus just like 1 or 2 days. So I might just end up buying that short side back, um, if especially if it doesn't increase the risk profile materially. Um, all right. So again, I mean, every trade is gonna be a little bit different. Not everything is gonna follow like a certain set of rules or a certain, specific guideline. But generally speaking, like these are like kind of like how these three scenarios are kind of how I approach spreads. So like whether it's like deep in the money, kind of like mixed in the, like at the money ish, or out of the money. I mean, that's kind of how I go about deciding like whether, I'm more risk, but more interested in taking risk off, or more interested in potentially holding, right? So there's a few factors at play, but you kind of have to like determine each individual trade, like the merits of each individual trade on its own, because there'll be, certain differences, certain nuances for each trade. So, but this is kind of like a good like guideline to go with. Okay, so let's we'll go over just a couple examples, just what I meant, like um, so. Um, So like when IBM, right, so like that was like a spread, right? So there was this was call spreads on the upside, and then put on the downside. It was like a strangle for earnings, right? So what happened was is that it gapped up, and like the long side of the call spread moved into the money on the day of its report. It went above 145 very briefly, but it didn't move enough to recover like the entire premium of the strangle. So like that's kind of like my day one rule when it comes to like events, or like strangles or straddles, is that um, if the stock doesn't move enough on that preliminary day, so like that initial session to recover, then I'm almost certainly not going to be adjusting it. Like I want like probably at minimum like that strangle to recover like 95% of the net debit, or the straddle, before I manage it on like that initial day. So IBM in that case, it didn't move enough. I mean, like the 145 call moved into the money, but not enough to recover like the net debit of the strangle, right? So after that, it pulled back, and like after like my 2 to 3 day rule, then the stock was down in like the 130s, 140 area, and the options were shorter term, and like it didn't seem like it was had any momentum, and realistically it didn't seem like there was like a chance it was going to work. So basically, like shorter term options, both out of the money. The premiums got hit very hard, but at the same time, like the probability of it working was lower. So like in that case, like that's something I'd be more interested in taking off quicker instead of like trying to hold, right? Obviously, like unforeseen, like the CEO stepped down and rip, but like generally, like this is like something like if you see a major reversal like this, after a quick pop and then a major reversal, and your options are out of the money and shorter term, like spread wise, like this is something that I'd be more interested in taking off, right? So Amazon, which I mentioned a few times, so like the stock gap significantly above the short end of like the 200 strike, right? And the options go out. They went out through this coming Friday, which is February 7th. So they were from when Amazon reported to when it opened the next day, there was basically only 6 days left until expiration for those contracts. So at that point, the stock was significantly in the money, and I knew that the options were going to that spread was going to open up quite a bit. So when it opened, it was trading from like anywhere from like 6.5 to like even up to like 8 points, and at that point, right? So with the spread 10 points wide, right? It was like a 1990 to 2000 spread, right? So like the max potential, if you held until expiration on Amazon, and that closed above 2000, the max potential that could be was 10 points, right? Because that's it's a 10 point wide spread. So on the day of earnings, when it gaps like above 2060, and that spread is 70 points in the money, 60, 70 points in the money, all right? The reward of that is going to be, so like the gain of that day is, so it's going to be in like the 6.5 to 8 point range, right? So at that rate, like your max potential gain if you held until expiration is like another 2, maybe 3 points, right? Versus if it rolled over and it got hit really hard and it dropped below 1990 and it closed this week at like 1980, then you basically go, the spread could theoretically close worthless, right? So with the trade worth, basically 3/4 of its max potential, then your risk to reward, the risk to reward profile is much more skewed to the downside than the upside. Like yes, you could hold until expiration and try to get the remainder, like 2, 3 points out of the trade, but then you also run the risk of it breaking down sharply and getting hit sharply, and then like instead of holding and trying to get 2 or 3 points, you give back 6, 7, 7.5 points, right? So from a risk to reward perspective, with it at like 7, 7.5 in that ballpark, your risk is much greater to the downside at that point than it is to the upside, because you could only theoretically make 10 and it's trading at like 7, 7.5. Whereas if it rolls over, then you could lose 7, 7.5, right? So that's why when it's that far in the money and it's that great above like that 50% threshold, I'd be more interested in closing that out quicker, right? If this opened at like 2150 and this was so far in the money that there was really, it seemed like improbable that, so or if the expiration was, say the expiration was Friday, right? So you like it literally expired that day. It opens at 2075. Then I'd be like, okay, maybe I will hold a little bit longer, because if this doesn't pull back 75 points today, then like these options have a pretty good chance of closing closer to like that 100% max gain potential, right? But because there's an extra week, there's more uncertainty, right? And then that's when I say like, okay, like maybe you want to be quicker to pull the trigger and get out of this one, all right? So you can see like there's different factors at play, but when it comes down to a spread, like one of the things that's always on my mind is that it's kind of like that 50% threshold, right? And like how does like the current gain of that spread compare to the 50% threshold? Because if it's above 50%, if it's significantly above 50%, so if like 75 or 80% of the max potential of that spread has been realized, then your risk is much greater to the downside, right? You run the risk of it reversing and losing. If that spread is only worth maybe like 15, 20, 30% of the max, then the risk is more to the upside, right? Because there's still a lot of profit potential if the thing starts to move in your favor. So then I'd be possibly more interested in holding, right? So that 50% threshold is something you want to think about when it comes to these spreads. And it could really help you kind of determine whether you want to be quicker to exit or maybe more interested in holding. All right? So you kind of see what I mean by that now. Like I thought like an example might be like a good idea to go over it, but it's really like it's like that 50% threshold of like the reward or of the max gain of like that spread. So if it's above 50%, then your risk is more the downside. If it's below 50%, then your risk is more the upside. All right. Any questions? It's something that's like it's just really worth going over because a lot of my style and like what I like to do is spreads. Whether it's swing trades or event trades, like I really do like spreads. And if you're following some of the ideas, or maybe if you have your ideas of your own and you're doing spreads, then it's like a really important aspect of managing these positions is like how you view it. What are your rules? What are your factors in going and determining whether you're getting in, whether you're getting out, whether you're holding, whether you're closing, right? So there's there's definitely more nuances um, to option strategies as you get more complex, right? Because standard calls and puts reasonably straightforward, but as you move up, like as you move deeper into the playbook, like I like to say, as you go into like spreads and flies and calendar spreads and all sorts of different strategies, then you really kind of have to like know your risk reward profile and really kind of have to have some sort of idea of like how you really want to approach those strategies from like a management point of view. Okay. Yeah, it's important. It's worth going over. It's worth spending some time on. And it was kind of fresh in my mind after like the Amazon move from Friday. So just I felt like it was worth just taking the time to go over it. Questions? Okay. So I guess kind of quickly, this week you still have a bunch of big names. I mean, Google tonight, which is it's down currently, but even outside of Google, I mean, um, Disney is definitely a big one. You got Snap, you got Twitter, um, FireEye. Well, FireEye's not big, but Chipotle, right? Like the Burrito King here. Chipstock, so Qualcomm, Clack, Uber is this week. Um, Twilio, so a big software report. So really, like I'm still focused on things that maybe haven't been participating and things that maybe more in consolidations, right? So that's one of the reasons why I really wasn't all that interested in Google. It's one of the reasons why I thought Amazon was more interesting than like than say Google or Apple or Microsoft is because Amazon really had not participated, right? Whereas Google is pretty. I mean, yes, it's off its low, but for the most part, it was on a great run for most of the last like three months, right? But that's why like this week, like I think again, it's really important. And what I'm going to be focused on is some of these names that maybe have better, you know, tighter tighter consolidations, tighter recent consolidations, things that maybe not have participated. Whether it's the last 3 months or the last year, right? So like that's why like one of the trade ideas going out tonight is Spotify. I still have the mock up here, but I thought Spotify was interesting because well first of all it kind of flies under the radar a bit, but what I thought was interesting is that if you go back from like a longer term perspective, kind of like it's off like this really critical area. It's trying to turn the corner after like a pretty lousy performance from its IPO, right? Last earnings report was pretty good, but what's nice is that it created like a pretty big gap underneath, and then you have like a really clean level above, and the options were only pricing in a move about half of what it moved in October. So options are seem a little bit underpriced because this hasn't really participated. It's got some clean levels, only about half, again, half of what it moved in October, which was about like 21. We're looking for about like 11, 11 and a half in that ballpark. So, like, these are the types of setups that are more interesting to me than like a Chipotle, Like, I know everybody's going to be watching Chipotle, but like, expectations are so high. The stock is up quite a bit. Options are expensive, and recently it hasn't really been like a big mover on earnings. So it this might get a ton of attention, but it's almost like the Google or like the Apple or the Microsoft, right? I mean, it's like it just doesn't seem as interesting from a trade perspective, right? Because like expectations are a lot higher, option pricing is a lot higher, and the performance has been a lot better, right? So like that's still going to be like my focus this week. Like the last like weeks pullback in the market has opened some things up a bit, but still, like I still feel like a lot of like these leadership names are still pretty overheated, and expectations are still pretty high. They haven't corrected that much. So like when I'm like screening this week, like I'm still going to really try to be particular. Still looking for like things that are consolidating better, maybe not performing, and if you see if you see me kind of like veering away from some of like um, the more popular names, that's really why, and that's why that's why last week you didn't see like a trade on Apple or Microsoft. Luckily for Facebook, it was up so much the day going into earnings that we were able to close that out and not actually take it into earnings, because that was like a surprise, and that surprise to the downside for their guidance. So like something that you kind of need to keep in the back of your mind, like these stocks that are up, like so Google will be like basically following like the Facebook pattern now, where Facebook was up like 7 or 8 points going into earnings, and then disappointed it got hit. Google was up almost 50 points ahead of earnings today. That disappointed it got hit. So things that are up a lot on the day of the reports, especially right now, it seems like it's more of an opportunity to take off risk versus being adding. Like you don't really want to be chasing these things higher, or at least like it hasn't warranted it so far this quarter. So definitely something to keep in the back of your mind, like as if you start to see maybe an idea that you had, or a stock that you're sitting in, really start to ramp very, very, very aggressively into like a report that night or the next morning. Maybe you want to be a little bit more risk averse and start taking some more money off. All right. Um, yeah. So I mean, plenty of still big ideas. Like it's plenty of big names. Like so, I got some ideas. Next week. Just like looking ahead quickly. I mean, you got a lot of big names next week too. So Alibaba, that's next week. Cisco next week. Shopify next week. Under Armour should be interesting next week. CVS, that'll be a big healthcare name next week. Roku, Nvidia, Expedia. So even though like some of like these major tech titans have reported, we actually still have quite a bit of volatile names left. So there's still going to be plenty of action. And to be honest, like if the market does pull back, or even if we chop around over the next few days, that could actually create like better setups into earnings. So I actually wouldn't mind that. So we'll see what happens though. All right. Um, any questions? Might be a good idea. A good place to take a break. I mean, kind of run a little bit over here. Anything about what we covered tonight? Yeah. Yeah, we went over a lot. Um, I try to do like these daily videos, just kind of give you an idea of maybe some things I'm looking at, or some like current like day-to-day developments. So if you should definitely check out those videos. Um, they're only like a few minutes long most of the time. Just kind of like going over like maybe some things that are just like crossing my radar that day, or things that are maybe on top of my mind after that session. So definitely check those out. And like, I've been trying to like read it up more, but on Fridays I'll do the earnings on the radar videos. So if you got time, like either Fridays or over the weekend, and you want to like go back, kind of like or game plan for the week ahead, because I won't do every setup. Obviously, like every like on any given day during earnings season, there might be like 50, 100 names reported. So I'm not going to do all of them. I don't know. I'll talk about like a lot of like the more interesting setups, like the price to move, maybe like the technical setup, like kind of my thoughts. So, if you're wondering, like, maybe what my opinion is on like Uber this week, you can like check it out. And, like, even though I might not trade it specifically, kind of like I'll go over like the setup and like my thoughts on it. All right. So definitely check those out. All right. Cool. So I guess yeah, it'll be a good place to like wrap it up. Um, but yeah, I mean, if you have any questions, like in the interim between like our the times we get together, like please don't hesitate to reach out. Like if I can help, I would love to. I mean, that's why I'm here. Like no question's a bad question. Okay, so please don't hesitate to reach out. Um, and yeah, I'm hoping for some good action this week. Some good responses to earnings. Crossing my fingers that just like an overall like higher volatility stretch here. It'd be great for some trade ideas. All right, cool. So have a great week. Best of luck trading, and I will talk to you guys all soon. All right, take care.